Hello, I'm David Lin, and this is Kitco News' first Insights interactive series for 2023. The Great Bitcoin Debate, Sound Money, or Tulip Mania, brought to you by Verified Investing Education. Today, we're bringing together two distinguished economists to discuss one of the most hotly debated topics of all time in the crypto sphere. Should Bitcoin be considered a form of money? Now, this question has implications for not only investors, but regulators and politicians around the world. Making the argument that Bitcoin does not fit an economist's standard definition of the term money is George Selgin, renowned economist who is a senior fellow and director emeritus of the Center for Financial Alternatives and Monetary Policy at the Cato Institute and the professor emeritus of economics at the University of Georgia. George is the author of numerous articles and books, including The Theory of Free Banking, and has been featured in many prominent media outlets, including the Wall Street Journal. He's currently working on a new book that examines the history of the New Deal and its role on the recovery from the Great Depression. On the other corner, we have Lyn Alden arguing for Bitcoin as an emergent form of money. Lyn is the founder of Lyn Alden Investment Strategy and is an accomplished macroeconomist herself. She's had her roots in engineering and started her investment research service in 2016. Important correct calls that she made last year in 2022 include the continuous series of rate hikes we've seen from the Federal Reserve and a continuous slowdown in the economy in the United States and around the world. George and Lyn, welcome to the show. It's a pleasure to have you both. I'm honored to be speaking to both of you about this very important topic. Welcome to Kitco.
Thanks, David. It's nice to be here.
Thanks for having us. It's great to meet George.
Yeah, absolutely. Lyn, I've worked with you for a number of years now. George, this is your first time on Kitco. Honored to have you in this debate format with Lyn, one of our more popular guests. The idea behind this debate spawned when the two of you had a dialogue on Twitter. Now, George, I'm just going to read a tweet that you made in October of 2022. You had said that when it comes to making the case that Bitcoin qualifies as money, Bitcoiners will try anything that is except consulting economists' standard definition of the term. Now, this tweet prompted responses from many prominent voices in the crypto community, including Lyn Alden, who is here today, and Michael Saylor, among others. Lyn, you responded with this tweet. If I go to an urban center of a random country and bring a non-local bearer asset money with me, Bitcoin is in the top decile of saleability. Dollars and gold at the top, then some euros, francs, yen, sterling, etc. Then Bitcoin. Naira, not so much. So we're going to be talking about this issue. We'll be taking audience questions around the 40-minute mark. So submit your questions in the chat box on the right-hand corner and make sure to hit that subscribe button. So with that said, I'll let each of you panelists make an opening statement to defend your positions, starting with you, George. Since you initiated this dialogue on Twitter, you each have about 3 minutes for this opening statement. So let's try to keep it to that limit. George, you have the floor.
Sure. Well, first of all, I do still believe what I said in that tweet. However, I don't disagree with what Lyn said in hers, so I'll have to unpack that for you a little bit. But let me step back a bit and try to get to the main point I was driving at in that tweet of my own. The whole idea of money is to get around the barter problem. And that means that with barter, you've got something you want to sell, something you want to get hold of, and you've got to look around for somebody who has what you've got and offers to take what you have. And that isn't always very easy. The principal idea of money, what makes something money, is that for whatever reason, everybody's willing to accept it in exchange at some price for whatever they've got to get rid of. And when you have that, that means that you don't have any search costs. When you go around, you find somebody who has what you want, you can, with high probability, you can trade with that person for this substance that everybody supposedly, or most everybody, agrees to accept. Okay, so that's the whole idea of money. That's what makes something money. It's generally accepted or commonly accepted in exchange. Now, the test for whether something's money is therefore whether you can go shopping with it with low search costs, where you can pretty much go into any shop or online these days, and whatever you're looking for, if you're equipped with this stuff, the seller is going to take it. My point about Bitcoin is very simple. It's that in most places, the vast majority of sellers aren't going to take it from you, or to put it perhaps a little bit more cleanly, there's something else, some other asset that they are much more likely to accept. And these days, that's usually whatever the local fiat money is. And just one more point. Now, what Lynn said was that Bitcoin is high on the salability list relative to all the other non-fiat currencies that are in use in the world. In any particular place, it's high on the list of alternatives. And that's true. But that still can be consistent with there being a big gap between its acceptability and the number of merchants, sellers who will trade for it, and the number who will trade for the local fiat money. So in that sense, these two tweets are reconcilable.
Okay.
Finally, I do think Bitcoin has made a lot of gains in acceptability, certainly since it was introduced. So my statement doesn't necessarily exclude it becoming money in more places in the future.
Okay. Lynn, I'll give you a chance to respond.
Well, I think probably along similar lines that I don't really disagree with anything that George said, at least in that description. And the way I'd phrase it is that, as he put it, basically you want to solve the barter problem. And the shortcoming of fiat currencies is that you only solve the barter problem in a local sense, right? So for example, in Egypt, Egyptian pounds solve the barter problem. It's a widely accepted medium of exchange there. But if you're in Canada, Egypt pounds are a terrible medium of exchange. Basically, they're only money in Egypt, maybe a couple border countries, you can get some degree of salability there. And the salability rapidly falls away outside of the local monopoly. So when you have 180 different currencies, I think something like 130 of them are free floating. The other ones are pegged, and therefore, pegs can break. You basically have a barter system globally, and only a handful of monies that basically tie them together. You have the global reserve currency. It used to be British pounds. Now it's dollars. You have gold coins. If you bring a gold coin with you, you can pretty much go anywhere. And my argument is essentially that if you look at, in a global sense, global bearer assets, what are the top 10 monies that you could bring with you that would be among the easiest to either get a vendor to, sell you something for them, or at least that you could then convert into the local, system fairly easily, right? So, for example, I have Norwegian kroner and Egyptian pounds in New Jersey, and basically they're less saleable here than Bitcoin is, for example. And that's true for a lot of places, suburbs and urban centers around the world, even though, of course, they're both highly saleable in their host jurisdictions, which is essentially an artificial monopoly. But that's the current technology stack that the world uses for lack of something better. And so my overall view is that, and it doesn't really disagree with George in that sense, is that it's an emerging money. It's not as saleable as, say, gold coins or physical cash dollars globally, for example. But I would say that the trend is very much up, and that it's already, you can look at, again, there's 180 fiat currencies, and then a bunch of other commodities. It's in the, I'd argue, the top 10, even after only a 14-year lifespan, let alone having a good trajectory. And it also comes with unique characteristics. For example, what makes it interesting as money is that, if you're trying to move money globally, right? If you try to bring gold through an airport, try to bring physical cash dollars through an airport, you're going to get all these checkpoints, all these ways to stop you, capital controls. The interesting thing about Bitcoin as a technology stack is you can memorize 12 words in your head, and you have like your slot on this decentralized cloud of money that you can then go around the world and eventually reconstruct your ability to access that, right? Or you can just send it to people, peer to peer in a way that it's challenging to stop. There are regulations and things that can try to slow it down around the margins, the fiat on and off ramps, but the actual network itself is rather interesting and kind of offers novel characteristics that a lot of other monies, basically haven't been able to offer.
All right, we're going to come back to that point a bit about the emerging technological advantages of Bitcoin and blockchain overall. But I want to come back to George first. Now, George, let's go back to your tweet and define how a standard economist would define the term money. Now, in textbooks around the world, we see that money is defined as being only qualified if the following qualities are met. So it has to be a store of value, medium of exchange, and unit of account. Does that definition still hold? I'd like to add some other characteristics too later on, but let's just start with those three.
Well, that textbook definition, I've written about this, is unfortunately not a good indicator of the real where expert monetary economists stand on this issue. What happens with textbooks is somebody writes one, they're always pretty half-assed, and then everybody copies it. And so they all end up saying the same thing, whether they're correct or not. If you consult the great monetary economists, I'll just mention a few names: William Stanley Jevons, Karl Menger, all of the Austrians, von Mises, Rothbard, but not just them. What you find is that they emphasize the primacy of the medium of exchange function over the others. And the simple practical implication is that you do have things that are stores of value that aren't money, and you have things that are units of account that aren't money, but you don't have things that are generally accepted media of exchange that aren't money. Anywhere where you have something that most people accept in payment of goods and services, that's money, whether it's a good store of value or not. And of course, that's why we can have monies that are crummy stores of value, as we all know, have existed and exist today in some countries. And all fiat monies are mediocre stores of value, but nobody says, oh, therefore they're not money because store of value is one of the three functions. Nobody says that, and that nobody believes it. So those textbooks are misleading when they use these three things, state these three functions as if they were equally essential. And I think that's very important. The general medium of exchange function, that's the one that rules the roost. And so if we want to ask whether Bitcoin is serving as money in any particular place, and then makes a very important point, most monies are not money everywhere. They're money in certain places. And so we can ask the same question of Bitcoin: where is it money? There are places where it qualifies more than in others, for sure. Bitcoin beat. But what we're asking is whether it's widely accepted in exchange. We know it's a store of value, but so are Microsoft shares, so is real estate, and we don't call them money. We want to know, if we're testing whether something's money, whether it's widely accepted in exchange. So that's the answer to the question about the definition that I'm calling the standard definition. Okay. It isn't a three-part definition. It's just the generally accepted medium of exchange component.
So, Lynn, a two-part question. So first, can you respond to George's point about the medium exchange component being more important than the others? And second, can you comment on Bitcoin being used as a medium of exchange, if that is the case?
Sure. I think the challenge with that definition is that it almost kind of presupposes that you can't have any money, because if money is a commonly accepted medium of exchange, it's one of those things where anyone's overly stickler on that term is going to miss emerging trends in money, or maybe emphasize them less than they might otherwise would. And so I instead view money as more like a spectrum, where I generally would prefer that three-part view of money. I think that's a more accurate way of actually assessing the moneyness of something. Because, for example, you can look at, say, art, like a Picasso painting, right? That's a store of value, right? But it's not liquid. It's not fungible. It's a rather poor form of money, yes. But it's a store of value. It's a bare asset. You can hold the Picasso. You can self-custody it. With Bitcoin, you have something that's a store of value, but then, unlike a Picasso, and then even more so than, say, stock and things like that, it's liquid, fungible, and a bare asset, self-custodiable. So it's basically designed in such a way that you can trade the store of value for other things rather easily. And so I think it has better characteristics of money than many other things. And so when you're looking at the moneyness of something, I mean, basically, like, Egyptian pounds and kroners are both kind of not very good stores of value. The kroner is historically better than the Egyptian pound in that regard, but they're both essentially melting ice cubes. In their jurisdictions, they're 10 out of 10 for a medium of exchange. When you go outside of their artificial monopoly, essentially their own country, they're like a 0 out of 10 or 1 out of 10 for medium of exchange. I mean, they're quite poor. And Whereas something like gold or Bitcoin, there's no area that's really as dense as these areas are in terms of their uses as a medium of exchange, right? So you go to Egypt, every single person there practically accepts Egyptian pounds. Gold, it'll take a little bit more friction to get it off your hands, but it will, it's not rocket science to find a way to do that. And whereas Bitcoin and gold and things like that, even dollars when you're outside of the country, they have decent salability, but they're never going to be as dense as a local monopoly currency, right? So I think the challenge with that definition is that it only really applies once something has already matured as a money. And I think it's not a very useful definition when we're analyzing an emergent asset for its potential moneyness, initially as a store of value, but then also saying how can this actually be used as money?
Yeah, can I push back against that a little bit, David?
Sure.
May I?
Of course.
Because the definition of money is a definition that tells you whether something is money. To say that something isn't money, according to the standard definition, isn't to say that it isn't something that can become money. If I define a dog, I think we all know what a dog is, so I won't elaborate. But if I define a dog and someone says, well, the problem with your definition is that, it doesn't really properly allow for puppies. Well, no, we have a word for that, puppies. Puppies are young dogs. It's a special thing. In the same way when I speak of what the definition of money is, it's true. I'm defining something that is a full-fledged money. But I'm not ruling out the fact that there are things that are capable of becoming money but aren't yet money. That's just that those things aren't money. They are becoming money or capable of becoming money, but that's not the same thing as being money. And just related to this, we can talk about the characteristics of a good money. And yes, a good money should be a good store of value, but it doesn't follow that a good store of value is part of a proper definition of money. If we agree that there can be monies that are lousy stores of value, like the Venezuelan currency today, the Cruzera, or I'm sorry, not the Cruzera. If the Bolivar is a lousy currency, it's still money. The same thing with Reichsmarks or papier marks in the early 1920s. We still consider them money. So we shouldn't confuse the characteristics of what we think would make a good money with the defining features of money, which some monies have, and which aren't necessarily all the good features that we'd like money to have.
Okay.
Right. I want to. So basically, I think one thing we can do is you don't necessarily have to have a Boolean outcome, right? So something is not necessarily money or not money. It's property of moneyness. And if we, for example, rank countries or rank currencies by their moneyness, right? So let's say we take a given country's currency. It's a 10 out of 10 in that country, but it's like a 1 out of 10 in most other countries. Whereas something like Bitcoin is like maybe a 3 out of 10 in a bunch of different countries, right? So it doesn't have it as dense of an epicenter as any of those monies in their own kind of artificial monopoly, but it actually has a broader reach of salability, higher moneyness outside of that, kind of artificially enforced density. Another way to kind of phrase it is if you have like an arcade, and there's an arcade token, and that token enables you to play games, maybe get meals, like, one of those like adult arcades, like where there's like, it's not like a kiddie arcade, there's like a bowling, there's entertainment, casino chips, for example. Those are something that is like money-like in a very small area, but then once you leave that establishment, it's terrible money. And nation-state money is essentially the same thing, but on a far grander scale. And so that's why I view that focusing on the medium of exchange asset capability is important, but we have to then separate, are we focusing on density in one area versus almost no density elsewhere? Or are we focusing something that's global and that doesn't have that density, but is still a global form of money in that sense?
Well, I want to agree with all that Lynn just said this time, if I may. I do think, first of all, that salability is what we're talking about. And the question is, where's the cutoff? When is something saleable enough to qualify as money. And that's not a hard, fast line. And it's a line that you draw differently for different contexts.
I'm going to bring it back to Bitcoin.
Like the world salability. There are very few things that qualify as money internationally, and among them, Bitcoin rates relatively high. I think that's fair.
There are some characteristics that Bitcoin has that proponents of Bitcoin have said that make it a superior form of money to some forms of fiat and perhaps even to gold. Now, I'm going to bring up these 2 points and I'll let you address whether or not they're important characteristics of money or should be regarded as important at all. The first is accessibility, and the second is fungibility. Now, accessibility, you can, with your phone, with internet access, with electricity, access Bitcoin from practically anywhere in the world. Now, the same cannot be said if you're, let's say, living in Lebanon and you want to access your Lebanese pounds and you have capital controls in your bank. You literally cannot go to the bank and withdraw past a certain amount. The second is fungibility. I mean, we've seen currencies in the past in ancient civilizations past. Cowries, seashells, for example, in West Africa were used as a medium of exchange, and they weren't exactly fungible. If you're talking about a barter system, if you had two cows for one goat and vice versa, the animals aren't exactly fungible. Bitcoin is, or at least that's what they argue it is. So are fungibility and accessibility important characteristics for moneyness? Whoever wants to take this first.
Well, I'll jump in and say they are desirable characteristics, but the fact that something's fungible and divisible doesn't make it money. One has to distinguish between the characteristics we would like to see in money that we think are desirable and what it is that makes something money. They aren't the same thing. So you have monies that have poor characteristics and you have non-monies that have good potential monetary characteristics. The being money is a market phenomenon. Money is a market phenomenon. That is, whether something's money or not is not a function of what its physical characteristics are. It's a function of what people do with it. And therefore, when we want to know if something's money, we can't simply look at it and say, well, it's got this physical feature or that physical feature. It's capable of this, capable of that. We must ask, who is doing what with it? And particularly, we have to ask, how easy is it for you to walk into the store next door and buy what you want, offering this stuff? That's a market characteristic, not a physical characteristic.
The way I would phrase it is that, so I agree with that, but I would say that the physical characteristics eventually dictate what the market does with it. For example, shells were money back when, tribes had similar levels of technology and basically nobody could cheat the system. But once someone comes and invents metal tools and, industrial revolution, anybody who's still trying to use shells as money is going to have a really bad time because there's other people that can then rapidly expand the supply of your money and you're going to get wrecked essentially. And so, properties eventually dictate market use. And so that's why you want to both take into account the properties of something, but then also identify, you look for market signals. Is this thing actually being used as money? Is the trend higher or lower? What is current relative value compared to money? And so, that's why a Picasso is just never going to be a very good form of money because even though it's a store of value, it's intrinsically rare, it's interesting, but it just lacks good properties to be any sort of medium of exchange, any sort of fungibility, any sort of liquidity. Basically it's not a saleable good. It's, buying something like Picasso is a very challenging process. Getting it authenticated, finding a wealthy buyer, it's a very challenging process. And so I would essentially describe that money is basically a ranking of saleability of different goods, and properties heavily dictate what is in practice a very saleable money. And then it just becomes a matter of, more and more market participants realizing its properties, testing its properties, seeing how those properties hold up, and then different technology trends over time can potentially break the saleability of some sort of monies. That's kind of been the history of commodity monies. That's why gold's kind of the last one standing. That's the one that we just don't know how to make more of at any sort of rapid pace. Whereas shells, beads, furs, cattle, salt, we can make all these things pretty rapidly, and we can sharply change their stock to flow ratios. Whereas gold and to a lesser extent silver hold up a lot better in that regard. And so Bitcoin, I think, has the properties of being good money. And then in a market sense, as we discussed earlier, it's got pretty good salability, especially when you look at it in a global sense.
Well, let me just jump in there and comment on gold and whether or not you think that some of the characteristics that gold has or has had in the past are now being shared by Bitcoin. Now, gold, as you know, throughout history has been used as money, but not just by one society, by different societies and civilizations through time. Civilizations that have had no contact with each other have had simultaneous usages of gold in various monetary capacities. So it's very clear that humans throughout time have viewed gold as a form of money. Now, I'm just going to ask, let's just start with Lynn first. What are the characteristics of gold that have held the test of time in this regard?
Well, mainly that it's long lasting, right? So it's very resistant to the elements. It's rather fungible liquid to a pretty high degree. And then, like, unlike many other commodities, it has a very high stock to flow ratio, meaning that it's very hard to make more of it relative to the amount that we already have. So the supply inflation rate is rather stable compared to most other commodities. And, shells also emerged on multiple continents as kind of early forms of proto money, as far as people can tell. And the difference was that once we achieved a certain level of technology, we rendered shells to be a poor form of money. Whereas gold is along with some other precious metals, but especially gold, is essentially the one commodity that we don't know how to increase at a rapid supply. NYDIG did a chart a year or two ago that showed gold over the past century, the estimated supply inflation rate of gold, above ground gold. And it was a narrow band between 1% and 2%, almost like clockwork for a century, averaging around 1.5% per year. And that, that basically is along with this, its high level of durability and resistant to corrosion and all of that. That's part of why it has such a high stock to flow. That makes it pretty good properties of money. Really, the only shortcomings it has is that it's not very divisible, right? Even a small, tiny gold coin historically was, more than like a week's, days or weeks worth of wages. That's why silver was highly used for a long period of time, because it had better divisibility for everyday use. And then number two is that it's not very fast, right? If you want to do global commerce, once we invented telecommunication systems in the 1800s, basically the telephone, the telegraph, undersea cables, we started linking all of our ledgers together. Settling with gold is just a more time-consuming process, and it's also hard to assay it. It's hard to verify that something's actually gold. It's pretty easy to do in small amounts. I mean, a gold coin's useful and kind of comes at a premium because it's not very cost-effective to fake a gold coin, whereas gold bars, you can do things with tungsten, you can wrap things around it, have similar density. It's a more costly process if you want to have a pretty high velocity, right? So you have to abstract it in some way. That's why you had gold-backed fiat currencies. And one of the advantages of Bitcoin, it does have some shortcomings relative to gold. I'm more confident that gold's going to be here 5,000 years from now than Bitcoin, right? If I had to pick between the two. But what essentially Bitcoin does is comes up with a very scarce liquid commodity with its own settlement layer, and has those similar properties. But unlike gold, it can actually move about the same speed as fiat. You can settle it globally in an hour. With a Lightning Network, you can settle it seconds on smaller amounts. And so that's kind of where its niche falls.
George, do you see any similarities between gold and silver right now? Gold and Bitcoin, rather, in the sense that you see Bitcoin adoption all around the world, maybe not to the same extent as other currencies, but it is picking up. And to my point about different civilizations using gold throughout different points of time, everyone around the world, to varying degrees, is using Bitcoin to varying degrees, mostly as a store of value or as an investment. But my point is, people are picking it up, and different groups of people around the world are using it. Is that sort of the beginning of the adoption of a form of money, like gold was maybe in its early days, thousands of years ago? Or is that a completely different example?
It's different, David. There are many respects in which Bitcoin and gold do resemble each other. So I should emphasize that first. I think Bitcoin is more like gold than it is like any established money. But I believe that partly because I don't think gold is really money anywhere. Again, to use Lynn's way of referring to things, gold is certainly more one of the most saleable things once you've gone past the list of prominent fiat monies, but it isn't nearly as saleable as most of those. And Bitcoin is up there. I see Bitcoin as the modern substitute for gold, as a parallel, very limited currency, but mostly as a store of value, a hedge store of value that is something people have reason to consider having in a portfolio instead of just having a lot of fiat assets. But I don't think that either gold or Bitcoin are really qualify as money in most places. Now, gold and Bitcoin each have different advantages or disadvantages, but I think we should downplay the purported difference between gold's and Bitcoin's ease of transacting, because gold, of course, the gold standard as it existed toward the end had a huge second layer, as we would call it today. Most gold payments were done with second layer technology, which back then meant people wrote checks or used convertible, redeemable paper banknotes. They didn't transact with gold itself. Even settlement was done among banks without actually moving a lot of gold around. So because of all that second layer technology, things could be less transacting with gold-based monies was not so inconvenient or slow or whatever. And today, most of the high-tech arrangements we have for transacting with fiat monies can be applied, could still be applied to a gold standard if we had such, as could many other kinds of digital transacting technology. So gold would still be the ultimate medium of account, but it could be a very efficient medium of account as far as that goes. So I don't think that ultimately the efficiency of a medium of exchange doesn't depend very much on the ultimate medium that is the medium that determines the standard. As long as you have a lot of good technology for moving claims or tokens or representatives of that medium around, which can be digital, then they're all capable of being very low cost exchange technology, exchange media.
David, can I jump in there real quick?
Yes, please.
I think one of the key innovations, or one of the key things that Bitcoin brings to the table, is that the actual bearer asset can move around quickly rather than just a claim on that asset. And I think one of the downsides, so I don't disagree with anything you said, but the challenge is that when you have something that relies on abstraction in order to move around efficiently, the challenge there is that it's easy to break that promise, break that peg, break that redeemability. And that's what we saw happen with literally every jurisdiction in the world. That you had the system, and I've argued that it's essentially that speed mismatch between commerce and the underlying settlement that allowed for governments and banks to be able to arbitrage that speed difference and eventually be able to break it. And when they broke it, and they had these fiat-only systems, the fact that if you could just teleport gold around and between people like mentally, right? It'd be really hard for fiat currencies to develop because what is their possible advantage over gold? And instead, their advantage was they were this big interlinked global ledger that could move around, and gold couldn't keep up, and so gold got rendered to just being a savings asset, for the most part, and a still a saleable, global asset, but not that quick medium of exchange that you have with fiat. And I think what Bitcoin essentially does is it says, okay, here's something that moves at the speed of fiat, but has the scarcity of gold, at least in the supply inflation rate sense. And so you have, I think, a reasonable shot at something where people can actually hold on to the underlying. They can self-custody the underlying. They can move around the underlying globally without relying on that counterparty trust.
If I may, I agree with everything you've just said, Lynn, and I've myself written about this. I had a paper, I think I originally wrote it in 2011, called Synthetic Commodity Money, that some people have seen in the audience probably. But the whole point of that paper was to say that Bitcoin has unique properties, unlike those of any other commodity money, and also unlike those of fiat money, some of which are quite advantageous, that could make it a better money, in some respects at least, than anything else. And so I think what you're mentioning about the fact that it's a base money that can move electronically, as it were, anywhere quickly, is one of those unique characteristics. There's nothing else quite like it. Well, nothing before the crypto innovations. But on a different related point, it isn't necessarily the case that a technologically superior money necessarily displaces a technologically inferior one. Let's take the case of fiat money versus gold. Now, it would be nice if what had actually happened was that the actual advantages of fiat money, the fact that it was more reliable, that people preferred it, was what made fiat money take the place of gold. But that isn't what happened. What happened was governments reneged on their commitments, having established central banks in most cases. And lo and behold, people found they couldn't have their gold, even though they still wanted it. And I'm not at this point going to launch into a debate about whether this was avoidable or not, or whether we're better off after all with fiat. Well, we all know that economists can debate the pros of fiat money versus gold forever. But the point is that this was not a simple question. This wasn't a story of how there was a new market innovation called fiat money, and the people said, "Oh, we like this better, and therefore we're going to do that." And the reason this doesn't happen, things don't happen that way with monetary selection, is partly because governments are involved, of course, and so they tend to have their way with whatever the people want. But it's also the case that an entrenched fiat money any entrenched money is very hard for a rival, even if it has technological advantages, to displace. We need to talk about this. I won't go on, but we need to talk about this network effects feature of money that makes technological innovation a very uphill battle in monetary standards.
I'm going to move on to one final topic, and then I'll move on to audience questions. A few great questions came in, so we're nearing the end of my segment, my questions. So if you're watching this now, feel free to submit your questions. A few of them already came in, so I'll move on to that very shortly. I'm going to start with George first. I know you are an advocate and you've researched free banking. I'll let you briefly, and under a minute, I know you can talk for hours, but just briefly explain the concept of free banking and why we've moved away from that into a centralized monetary authority. Let's just do that first, and then I have a follow-up, but yes.
Well, this is still related to the gold standard or the silver standards of the past. And when those existed, there basically were two choices that were prominently debated. One was having one bank only issue paper currency, and the other was letting paper banknotes be issued competitively. And free banking is a name for those systems where banknotes were competitively issued. These were again redeemable in gold and silver, but more specifically, it refers to those banking systems where not only was there competition among different private issuers of paper money, but there was also a relatively light-handed regulation in general of the banks.
Right.
And a few such systems existed historically, and they were very successful. So we've tried to get people to pay more attention to those success stories and to try to understand why they work well.
Okay. Lynn, I'm going to ask you this question a slightly different way. There's been this trend on social media among some Bitcoin proponents and actually blockchain proponents at large that there should be a separation between state and money. It kind of goes back to the idea of free banking, which is what George was just talking about. I'm going to ask you this. Suppose we colonize Mars or any planet, where, a new territory, and we were to establish a new form of currency. What would that currency look like? Should there be state intervention, or should it be completely peer-to-peer?
Well, I think that would depend on who established Mars and how big that colony is.
Okay.
And I think should doesn't necessarily mean like that. That's what happens in practice, right? And so I do agree with George's prior point about how, fiat didn't replace gold necessarily in a voluntary way. People, didn't self-select for it and then push gold away. However, I would, and this ties into your question, I would point out that, people freely accepted using banknotes when they thought they were redeemable for gold, right? So it's not that they were forced to use that. Basically, they came in and they solved an actual problem, including free banking. Like basically, that a private entity would collect gold, issue banknotes, perform banking services, and that would essentially solve some of the the shortcomings that gold has. And the essentially problem is that because you had that mismatch between the gold's proper like store of value characteristics, whereas it's not very fast, it's not very divisible, and it got centralized. Because of that, it essentially allowed for a massive rug pull. Basically, all that gold centralizes, and then it's all in the banks, and then the governments can come in, and there's only a few honeypots to go after. Basically, they essentially then control all the gold, and then they can say, okay, now we're going to have these standardized banknotes, and then, oh, by the way, they're not redeemed for gold anymore. Basically, it's this series of rug pulls that leads to all the gold being centralized and detached from the currency. And so you still had people desiring something that moved faster that they thought was redeemable. And just the challenge was that because of that mismatch, they were basically shorts, they were short on that promise. And so whereas something like Bitcoin, because it's actually the bare asset that you can hold, it's harder to get rug pulled. Now there still are questions around the long-term network. Is it gonna remain, say, resistant to 51% censorship attacks by miners? What happens if governments do try to ban it? We do have some, kind of points on that. For example, in Nigeria, it's not the strongest currency in the world. A lot of people prefer dollars. They prefer Bitcoin. They prefer stable coins, whatever the case may be. And so what Nigeria did was they didn't ban it, but they cut it off from their fiat system. They said, okay, banks can't send money to crypto exchanges. Yeah. And yet you still have a very, very high adoption of Bitcoin and other digital assets like stable coins in Nigeria. And that's because, when there's a strong desire for it, people are able to more easily go around it. And the cost of enforcement, it's very easy for a government to enforce things on banks. You just tell the banks in the country, you can't do X, Y, Z. And of course, every single one complies. Whereas if you're trying to enforce things at the individual level, that's a much more costly form of enforcement. Okay. And so, yeah.
All right. I have a few audience questions that came in. A few people asked about CBDC, central bank digital currencies, and its effects, its inevitable effects on Bitcoin and gold. Let's just keep it broad. Is CBDCs a form of fiat? How would you characterize this? Is it a form of money?
Well, it presumably would be, and it would be a form of fiat money. It would be a digital fiat money, digital retail fiat money. Right now we have paper fiat retail fiat money, and we have digital wholesale fiat money, which is bank reserves. So this would be digital retail.
How do you feel about this? Would this be a superior or inferior form of our current monetary system?
Well, I'm a guy who wishes that commercial banks would be issuing the paper money. So obviously, I don't think that central banks are that it's desirable to have a monopoly of any kind of retail money. I think that it would be better to allow the private sector to supply all forms of digital retail money. It's capable of doing it much more efficiently than central banks, with more ongoing innovations. And I believe stable coins are part of the a part of the set of retail digital monies that can compete with and should in fact be allowed to prosper instead of central bank digital currency. There's no advantage, and there are many disadvantages of having the government enter into the digital retail payment medium space.
Okay. Lynn, how do you feel about CBDCs?
So I don't think that's an area where George and I are going to disagree much. So I agree with everything he said. One caveat I'd point out is that when you ask if something's a preferable form of money, you have to analyze the question from both the issuer's perspective and the user's perspective, right? So I can see why governments want to issue central bank digital currencies. It gives them greater surveillance capabilities. They can program different interest rates more easily for different regions or different groups of people, and they can freeze people's money. I mean, there's all sorts of things that they can do if they have digital retail money. Whereas from a user perspective, cash is, physical cash especially is a private medium of exchange. It's one of the relatively few forms of transactional privacy that people still have, which is actually a pretty significant reason why governments would prefer to minimize it. And so from a user's perspective, you would generally prefer to have your choice of money. So you'd prefer to have, maybe there's some contexts you want private money. There's other times you want the convenience of super fast digital money.
Yeah.
And that people could pick the type of money that most suits what they're after. And it also depends on where you are in the world. I mean, for a lot of people, privacy is a bad word, but I mean, something like 50% of countries in the world are classified as authoritarian in some way. And there's some significant degree of curtailment of individual liberties, arbitrary bank freezes, not very strong rule of law, right? And so, in many parts of the world, the right to transact is essentially a human right, or even in the the UN, one of the articles is right to privacy. We also have, in the US, there's, the amendment, basically protection against arbitrary searches and seizures. Basically, privacy is one of those things that goes back pretty far, that people want reasonable degrees of it. And cash is one that people still have in that regard.
Okay. This is an interesting question. It came in from a user by the name of Dave Barrowman. Lynn, I'll let you take this one first. Isn't Bitcoin just an NFT with a fixed count?
Sorry, was that to me or?
Yeah, well, whoever wants to take it, I'll let you take it first, Lynn. Isn't Bitcoin just an NFT, a non-fungible token with a fixed count?
Well, non-fungible basically means it's non-fungible, whereas Bitcoin is pretty fungible. There's actually different degrees of fungibility, right? So, for example, individual UTXOs are moderately fungible. They're still somewhat trackable. The way I would describe it, I think that's a way to describe it for people that generally promote other blockchains. And the challenge there is that NFTs are generally running on blockchains that are pretty centralized. And so in many ways, I would describe a lot of those systems, including the NFTs that run on them, as a form of fiat, essentially. You're still using a rather centralized ledger. So I would say that I would not describe Bitcoin as an NFT. Instead, I would describe it as, out of all the cryptocurrencies that exist, it's the one that is most optimized for true decentralization.
Okay. What is your outlook for the Bitcoin price? Do you have an outlook for the Bitcoin price for the next 6 months? Either one of you?
So, George, do you want to take that?
Well, I'll take it to a negative way. This gives me an opportunity to say that I don't believe that it's a tulip mania thing. I don't believe that Bitcoin is really worthless. I got lumped in with people who make statements like that because of my much more moderate concerns about Bitcoin. I really honestly don't have a strong opinion about where the price of Bitcoin is going, except to say that I think it's foolhardy for people to dismiss Bitcoin as something that's bound to collapse anytime, or to be overly optimistic about it going to 100,000 or 200,000 or any number of other large numbers that we hear bandied about. But I don't pretend to know whether it's more likely to head in one direction than in the other.
The question came in for you, George, from, I know we're running out of time, is Purple Pie Man asked, do you own any Bitcoin, George? And if not, what would change your mind?
I do own some Bitcoin. I'm not going to elaborate. So okay, that's the answer.
So you, all right, so no changing your mind there. Lynn, I have another question for you. So suppose we have, actually there's current news going on about Coinbase. Is there any relationship between Coinbase and Bitcoin right now?
I would say not significantly. And if anything, over the past couple of years, we've had a divergence between Bitcoin and the broader crypto space, right? So, for example, you see that the CEO of Coinbase has like a .eth on his Twitter handle, for example. You've seen kind of this emergence of Bitcoin-only companies, right? So ones that are just, instead of going onto an exchange, it's kind of a casino environment. You trade multiple different cryptos. Most of them lose their value significantly over the long term, especially in Bitcoin terms. Instead, you've had this kind of rise of a separate Bitcoin-only ecosystem. And obviously, on the exchanges, you still have overlaps of those Venn diagrams. And so, there are many people in the space that actually view that are Bitcoin proponents that have a negative view of Coinbase and a negative view of some of these large exchanges. So I would say there's actually quite a divergence between them. But obviously, when you have a bear market in the broad space, that's when you get a lot of layoffs and weakness across the whole space. I mean, Coinbase was not laying people off in the raging bull market in Bitcoin and cryptos. They are laying people off now that there's a trough in the market. So in that sense, they're connected.
Okay. We've talked about how you two feel about Bitcoin as a form of money, but just looking around the world at how regulators are responding to Bitcoin or categorizing Bitcoin, what do you think they're thinking? Do they think it's a form of money? I'm not talking about El Salvador or West Africa. I'm talking about, let's take the United States or the G7, for example.
Well, sure. I would like them to regulate it as a potential form of money. And what I mean by that is I would like them to regulate it so that it doesn't face any disadvantages in becoming money if that's what people want to use it for. And so I don't like it being treated subject to capital gains taxes and that sort of thing. Unfortunately, it's hard to draw a line. If you say to the tax authorities, look, you shouldn't tax things that might become money differently than you tax monies themselves or money itself, then the question is, where do you draw the line? What do you include among these potential monies? Right. But if you were going to include anything, I think that Bitcoin would be the highest or very high on the list. Okay. So I don't want the government to have any laws that stand in the way of and artificially limit the potential for Bitcoin becoming a real money anywhere.
All right, I have one more question. I know we have to leave soon, so I have one more question, a minute each for each of you. Lynn, I didn't have a chance to let you answer this question yet. What is your Bitcoin price outlook for the next 6 months?
So I think 6 months is almost entirely a question of liquidity, right? So there's basically in the near term, Bitcoin is generally highly correlated to global measures of liquidity. There's a number of ways to do that. So generally when you have, say, global M2 denominated in dollars going up, generally Bitcoin is doing pretty well in that environment. And generally it's doing pretty poorly when you have that number either going flat to down, which can either happen because global M2 stopped increasing or because the dollar has strengthened relative to many other currencies. So the way I've been phrasing it to my readers is that I have a very uncertain outlook with, say, a 6-month perspective. But I'm, quite bullish with, say, a 3 to 5 year perspective on the asset, that I think all the structural characteristics are still favorable for its a high likelihood of long-term appreciation, but that, in any sort of 2-quarter period, it's obviously a very volatile asset it can be shoved around by all sorts of macro forces.
Okay. George, this is, thank you, Lynn. Final question for you, and then we have to get going. So, gold standard, return to a gold standard where any sort of pegged currency standard. Is that something that's in the cards for our economy anytime soon? Should we return to a gold standard or a commodity-based economy?
Well, it's certainly not in the cards, David. There's simply not enough support for such a transition. The vast majority of experts and policymakers think it would be a terrible idea. That doesn't mean that it necessarily would, but that's the state of thought. And but as for whether it should be done, there are some real challenges apart from the question of popularity, because the gold standard that I think, and many people think, but those economic historians generally understand that the gold standard that existed before World War I had a lot of great features. Mm-hmm. Replicating that would be exceedingly difficult, because one of the things that made it work so well was that a whole bunch of countries were involved. How do you get that back? I don't know a way to recreate such a standard.
All right, well, we have to let you both go. It's 3 o'clock. Thank you very much for your participation, George and Lynn. It's been a fascinating discussion. So I look forward to having you back both at another time. And thank you for watching Kitco News. I'm David Lynn. Subscribe to our YouTube channel if you haven't already. And thank you to our sponsor, Verified Investing Education. George and Lynn, thank you again.
You're welcome. Thank you.